This is going to be the most important video you ever watch on trading, I promise. I've been trading since I was in my 20s, and during the last decade I've helped coach thousands of traders from complete beginners to full-time professionals. In all that time, there's one thing that's glaringly obvious. One clear thing that separates traders who consistently make money from traders who don't. And it's not indicators, it's not mindset, it's not psychology. It's backtesting. Backtesting is the most important skill in trading. I don't care what anyone says. But it's also the most avoided because it's not sexy, it's not exciting, it's not something you can show off on Instagram. It's just hard work, boring work, especially for those who aren't really in love with trading itself, which is most people. But it forces you to focus on process instead of chasing outcomes all the time. And that is exactly why it's the dividing line between amateurs and professionals. Traders who avoid backtesting are usually chasing a shortcut. Traders who embrace it are building a career. So in this video, I'm going to show you exactly step by step how professionals actually backtest. And this isn't going to be my theory. It's not going to be my opinions. It's not going to be trust me bro strategies. I'm going to show you how to test a strategy on historical data, how to prove whether it actually has a positive expectancy, how to measure drawdown, consistency and risk, and how to know before you risk real money whether a strategy is even worth trading. Basically, everything that separates the winning traders from the losers. I'll show you how to set this up properly, what platforms to use, what software to use, exactly what to record, how many trades you actually need, and how professionals review performance to optimize a strategy and make it better rather than destroy it. I'll even show you how you can access the exact professional grade backtesting spreadsheet and structure that I use, as well as a template you can copy. And I'm going to give you my honest opinion on automated backtesting versus manual testing, and when each one actually makes sense. This video won't make you rich overnight, but if you want to trade profitably, not just for weeks or for months, but for years profitably, this will be the most important trading video you ever watch. Because trading without backtesting isn't trading, it's gambling. So let's break it down properly. Get a pen and paper and remove distractions because this is going to be a long video and one you're going to want to watch again. So save it to your watch later. Download it if you have YouTube Premium. Let's go. All right, you made it past the introduction and good job, because as I say, if you don't get this right, you won't be profitable trading. I can almost guarantee that, right? So we're going to cover everything. We're going to go through everything, and you're in for a real treat. But the first thing I want to reinforce, if you like, because this is kind of where you get the arguments of in the comments from people who just can't be bothered to do the work, right? It's the three reasons that backtesting is absolutely critical for you to be a successful trader. There's three main reasons. I mean, there's tons and tons of benefits, but there's three big ones. The first one is something called your reticular activating system. Okay, so your RAS. And what your RAS is part of your brain that stops you from focusing on everything and going mad. Basically, it stops you from being hypersensitive and hyper aware to everything in your surroundings, and it allows your brain to focus on familiar patterns that pop out to you, that are familiar, and you see things because you've trained that part of your brain to see that particular pattern. So if you've ever gone and bought a particular car in your life, the chances are that when you got the car, all of a sudden you see them everywhere. Or when you start seeing something that you want online and you're searching for it, all of a sudden you see them everywhere. That's your reticular activating system popping out familiar patterns that are now familiar, that you didn't need to focus on before, but now you do. Now it puts them in your awareness. And what that does in trading is, the more you backtest these patterns and familiarize yourself with these rules of engagement in your strategies, they start popping out to you, which gives you a massive edge. You see these patterns everywhere. Whereas other traders that are diluting their focus across all these different things, they're not going to have the edge that you do. So putting in the reps into the market is going to allow to train that part of your brain, and it's going to allow you to see patterns very, very quickly, and they're going to pop out to you. That's the first step, because you're focusing on testing lots of these. The second one is confidence and emotion, right? So hear me out here, right? Because I've asked this question many, many times to anyone who just says, oh, you don't need to backtest, right? I always ask them, why wouldn't you? And I've never ever had an answer to that, right? Because they can't answer, because the only answer to it is because I can't be bothered, right? And that's not going to get you profits. And hear me out. All profitable trading is your ability to consistently trade with discipline a set of rules that you know have an edge over the market. And the only way you really know that, because we never know what's going to happen going forward, the only way we know that is because we know what happened in the past. And the only thing that's going to give you that mental strength, that confidence to trust the future, is because of that data in the past. Not just because you see that it's a winning setup or a winning trading strategy, but also your maximum loss in the past, your maximum drawdown in the past, how well it performs on certain markets. Maybe it doesn't perform well on a certain market. Maybe it doesn't perform well at a certain time of year or time of week or time of day. But you'll never know that unless you've got the tested data, and that's all you've got to go on going forward. So if psychology is the most important thing in trading, and you need true mental strength, your psychology needs to be at its A game more than any other, most other professions, right? Why wouldn't you? Why wouldn't you have that? That's what you need most. So once you start to go into a drawdown in real life, you can look back at the data and go, well, this keeps me calm because I know that, my maximum losing streak was 10 in a row, and that was in 2015 or 2017, and you can say my maximum drawdown was 6%, and that was over 4 months. But you don't know any of that if you haven't tested it. So if there's anyone in the comments here saying, oh, you don't need to do all that testing and stuff, why wouldn't you? Please tell me. Give me a valid reason as to how you plan on being profitable without it. And then lastly, which is the magic which no one really talks about, is optimization and performance. Once you get into the habit of testing, you can now use pivot tables. I'm going to give you a phenomenal insight into a tool that you won't have seen anywhere else out there, but I'm going to show you how important that is. How having that data allows you to really ramp up and dial in your edge to accelerate the performance of that strategy. And also, that's your tested data so that you can go live confidently. But once you're going live, the backtesting then becomes your just regular journal routine, which there's a few other things that you're going to add in there. But once you're journaling, then that becomes your new backtested data, so that when you do a quarterly review or an annual review, you're not losing money over time. You're actually enhancing and optimizing your strategy so that you can continue to earn profits. Because once you develop an edge in trading and you've got this trading strategy, that edge is deteriorating very slowly over time. And if you don't keep on top of it and you don't have a way of optimizing that and optimizing the performance, you end up in a place where all of a sudden it's not making you money anymore, and now you're experiencing a death by 1,000 cuts. You don't know what to do. You don't know where you have to start all over again. You didn't see the person the employee stealing from the till, or stealing your stock. It's just these small things that happen, and if you're not on top of that and you have no idea where that's coming from, you've now got to start all over again. Okay, so those are the three main and pretty big reasons why you need to do this. So at this point, just type into the comments, right? And just let me know that you're still here, and type in backtesting, right? And just put that in the comments and I'll know that you're still here and you're taking this seriously. Because I know that when you go over and you follow those people who are just showing off their kind of strategies, the winning trade or whatever, you might go and have a bit of luck with that, right? But what you don't understand is that is just a snapshot in time of that particular performing trade. It is not, you don't know if it does, you don't know if it doesn't work on different time frames or different times of week or different times of day or different pairs or different, it's crazy. You could just be trading something blind and not knowing what results it could yield, and then you're just hoping and praying. We don't want to do that anymore. All right, so what is backtesting? Let's really cut to the point here. I'm going to take you through this process, and first of all, you have to understand what backtesting is. And all backtesting is a process of testing historical data. That's it. You're going to go and do a test of historical data, and you're going to develop a strategy that is tested, repeated, and verified. And those are the three main important things, okay? Any strategy you develop has to be testable, repeatable, and verifiable. Once you're tested, repeated, and verified, you're good to go. You know that the strategy has a positive expectancy, which I'll talk about in just a bit, and I'll demonstrate that for you. So what I'm going to do is I'm going to take you through building out a strategy, how we're going to put that into what we need to record on the backtesting, how we fill in the sheet, okay? And then I'm going to take you into a deep, really professional grade tool that I use, many of my other traders use as well, and I'm going to dive into that. So let's get stuck in. Okay, so first of all, let's talk about what you might include in a backtesting spreadsheet. Now, you're looking at a very simple backtesting spreadsheet. I've created this in Google Sheets. You can download this and use it in Excel. We might build one in Excel, but these, as a minimum, are what you need to log as you're testing these strategies. And in a moment, I'm going to take you out to a chart. We're going to go through this in real time. I'm going to fill a couple of these in real time. Then I'm going to show you the good stuff, the pro sheet as well. But this is really all you need. And the reason you need some of these entry criteria, I'm going to explain now. So the first, you can see I've got trade date, I've got setup notes, I've got order info and exit info, right? Now, the entry date, the reason it's important to log the entry date is because for two reasons, really. One, you're going to want to know the date of every trade, because as you start to log these things down and you go into optimize and review the performance of the thing, you might use optimization tables, pivot tables and things, which I'll explain in a moment, to start looking at there's a common pattern in dates where these things are not profitable. Maybe it's August, maybe it's Wednesday, right? Maybe it's Monday, maybe it's Friday, and you can start to see patterns in that. But the second most powerful thing about logging the entry date is when you do your first series of testing, you're going to have some ideas that you might want to tweak. So as you carry out a test, you might go, oh, I wonder if I change this or that about the strategy and what difference that will make to the performance. Well, now, because you've got the entry date, you can quickly go straight back, find that trade, tweak it, and do what you need to, rather than go and do the whole test again. That's a big mistake that I made back in the day, and that is going to happen. So what typically happens in testing is you test one strategy and then you have these ideas, and then you go and do it again, and then you might have another idea and you go and do it again. You have to flush out those ideas. So I recommend you just stick to one strategy, one time frame, one pair, one market, and you go and do that until you flushed out those ideas before you roll it out onto the rest of the pairs, because you don't want to go and retest them all again, right? So just bear that in mind. So entry date's really important. Entry time, we're going to want to know what time of day we got in, again, for optimization, and also time of day you're willing to trade the strategy. You might be asleep at 3 in the morning and not willing to get up to trade at 3 in the morning. And if you develop this system and you go, oh, great, it's got a, positive expectancy and a 67% strike rate and all this kind of stuff. Well, if 70% of your trades happen at 3 in the morning, are you going to be awake, and are you willing to get up and be awake? Maybe not, right? So this time of entry is going to be great to see those patterns as well. Currency pair, so what market you're going to be trading. As I say, I recommend you start testing one market, one time frame, one strategy at a time. You'll help build your RAS. If you're focused on multiple strategies at once, you're going to dilute the RAS, right? You're going to be like, this is what ADHD people have. They have a less finely attuned RAS, so they're hypersensitive to everything. That's what RAS is. The time frame, so the currency pair might be the pound dollar. The time frame will be the 4-hour or the 60 or the daily or the weekly or whatever you're trading. The type of trading system, so you might be trading Elliott waves or Fibonacci ratio patterns, a bat pattern, or you might be trading reversals or trend continuation. Okay, so you might be trading an RSI setup, something like that. Type of entry might be a double top or a 3-bar reversal, or your entry, your candlestick entry signal, or an overbought condition, or whatever that might be. That's how you enter next bar market. Condition is, these are just kind of notes on setup. So some of these aren't relevant to all systems. This is just something I have for my swing trading system, where I've got checkboxes for like support and resistance check, indicators check, and all that kind of stuff. But the condition, you might need a bullish or an overbought or whatever, right? So you might have a couple of notes there. And then the order info is the entry price, the stop loss, the target zones, where you got in, where you got out, and the close date, close time. You want to do all of that stuff as well. So you might be asking, okay, you've got entry price, stop loss, target, and all the rest of it. Why have you got position 1 exit, position 2 exit, position 3 exit, and P&L? Well, you want to enter the trade as per the rules, okay? So that, you know, your initial entry price, your initial stop loss price, your initial target price, and then what you can use over here, is the position exit. So the position exit might be the stop loss if you got stopped out, and then you can calculate if it was a negative, or, you know, you can actually program this thing to say, if we're bullish and we get a negative pip value, then I know that that's a loss. Or if we're bullish and we get a positive pip value, I know that's a win, and I'll add those pips to a positive figure in the P&L. So you can do all that kind of stuff. Don't worry too much about that at the moment. I'm going to show you a phenomenal tool that does all that for you. But that's, you want to keep track of your P&L. Okay, you want to keep track of your P&L in terms of pips gain, pips lost, and then from that you can calculate your strike rate and everything. Right. So let's get stuck into some charts, shall we? And kind of give you an example of what we're going to be doing here. So I'm going to move this over here, and I'm going to extend out our chart. Okay, so we're on the pound dollar for this example, and I'm going to go through how I would track the trades. Now, before I get into that, I want to recommend that the minimum sample size for your testing, so this is one of the biggest questions that I get, is you want to test at least 100 trades or 5 years, whatever comes first. So 100 trades on the hourly, you might get that within a 5-year period. On the 15-minute time frame, you'll get that way quicker than 5 years. Okay, but 100 trades or 5 years, that will give you a really nice sample size covering all seasonality, and you'll cover all bases, right? So it's a really good starting point. Some of the traders like to do 10 years, some even do 20 years, but 5 years or 100 trades is a minimum as in my recommendation. Okay, so just for the sake of this video, we're going to go with a RSI oversold strategy, because it's going to be really simple to follow. And of course, the strategy isn't the thing of this video. Your rules of engagement need to be board game instructions. They need to be very objective, okay, and very, very clear, so that you could give them to a 10-year-old and they could read them and follow them. If they can't, then you've got subjectivity in your board game instructions, your strategy rules, and you need to iron those out. You know, when you come to develop trading strategies using code, and you do indicators and things like that, you have to be very, very binary. So it kind of forces you to iron out any of that subjectivity. But you're going to need to do that as a trader. Anyone needs to be able to follow step by step, like a cockpit checklist for a pilot flying for the 10,000th time. They still go through that checklist because it's consistent. And if you want consistent profits, you're going to need a consistent plan. So just for the sake of this video, what we're going to say is, step one, we're going to wait for the RSI, which is the relative strength indicator down here, to go oversold, below 20. Soon as we go oversold, we're going to wait for the candle to close, and we're going to enter next bar market. And then our stop loss is going to go 15 pips below the entry, okay? And our target is going to go 25 pips above the entry in a bullish case, okay? So that's it. We're just looking for bullish setups, and you can see here RSI went oversold right here on this candle. So we're going to wait for this candle to close, which would be down here. This is the close at 34.37, and then our stop loss is going to be 15 pips away from that. So really, really quick, we could just bring on our position tool here, and let's just do this. So pretend we've gone back 5 years, say, or we're going back in history. We've gone back to the way back in time, 5 years, and we're going to go, right, okay, so we want 15 pips from here, which is going to put us here, right, at 34.22. And our target, as I said, from entry is going to be 25 pips. So 24, 25. Okay, so we're going to go right here for 25 pips, which gives us 1.67 to 1. Our target's going to be up at 34.62. Entries here, stop loss here, right? So what do we do? How do we test this? Okay, well, here's what we do. So we're going to bring this on and we're going to start filling this in. Now, the entry date would have been after the close of this candle, right? This is the hourly chart. We're looking at the hourly chart. So this candle here is the 3 o'clock candle, okay? So 3 p.m. in the UK on the 24th of September 2025. So we're going to say, right, it's the 24th of the 9th, 2025. The entry time was 3 p.m. Okay, the currency pair in this case is the GBP USD. The time frame is the 60. We're going to use our trading system's going to be our RSI strategy, oversold strat. Okay, the type of entry is going to be next bar market, which basically just, again, this isn't about strategies, but it means that I'm entering live at market on the next open of the next candle. That's all that means. Condition, we don't really need to fill these in, but we could put oversold here, you know, and all the rest of it. That's not really relevant. And then entry price is, of course, all the details are on here now. So the entry price here is going to be at 34.37, so 1.3437. Whoops. 1.3437. The stop loss is going to be here at 1.3422. 1.3422. Now, this might seem like it's a little bit grueling and a little bit mundane and monotonous, and it takes a long time. And I'll be honest with you, it's probably going to take about 20 hours per strategy, per time frame, per pair. Okay, so I got it down to about 18-20 hours on a good day, and I used to do that over a few days. I used to do a lot on a Saturday and, you know, evenings and things like that. But roughly 20 hours per strategy, per pair, per time frame is what it's going to take you. My first initial round of testing was over 600 hours. So this is why people can't be bothered to do this. Instead of accept that this is what you need to do, they deny themselves that, oh, you don't need to do that, there must be another way, and they ignore it, they neglect it, and they just go around in circles. Okay, the beauty of doing this is you start to feel connected to the market. You start to feel connected to the numbers. Your true blood, sweat and tears goes into the analysis of the data, and you're collecting it. And guess what? Because you've gone through every single trade and seen it with your bare eyes, you trust it. You know that no one duped these numbers. There wasn't an automated system saying, oh, look, it's profitable, just trade it. Because ultimately you've got to put your money into the market and trust this 100%. And if you haven't done this, you can see why you wouldn't, right? You just won't. It's no different to someone just saying, oh, take this stock tip or go and buy Aussie CAD. It just won't work. Okay, so look, our target here, we're only taking one target in this case, not multiple, but 34.62. So 1.3462. All right. Now, you can see that we've entered at 34.37 and our target is at 34.62. Okay. Now, our close date. So how did the trade play out? You can see this one, we didn't actually hit targets until this candle here would have taken us out. Okay, so this is 4 a.m. on the 25th, so the next day, overnight. So this is the 25th of the 9th, 2025, and the close time was 0400. That was going to be in the morning, and then the exit price is going to be our target. Now it could be our stop loss if we got stopped out. So position 1 exit is going to be our target, which is again 34.62, so 1.3462. Okay. And then what you can do is on the P&L, you can put formulas in this. This is a very basic spreadsheet, but you can put formulas in this to say, okay, deduct one from the other to give me a positive figure of however many pips. So in this case, if we were bullish, okay, we rallied, so it's a positive figure. And if our entry price is 34.37 and our target price is 34.62, if you take away one from the other, that is a 25 pip winner. Okay, now if it was a negative figure, you might put it in brackets or put a minus. If you put 25 in brackets, it will be a minus figure. Okay, and then that you can use that to calculate the overall performance in terms of P&L. So this is a 25 pip winner. All right, let's just do another one before I show you the good stuff. So we carry on. This one played out. And another great thing about this is, you know, when you're in certain trades, if there's another opportunity and you're already in the last one, then you wouldn't have realistically taken the next one, would you? Because you'd still be in the trade. So if it's going on over a series of a day or 2 days and another opportunity arises, well, you couldn't have taken the second one because you're still in the first one. And people capture all of the trades and then they give themselves unrealistic expectations. And then when they start trading it live, they're like, this isn't matching up. You know, if anything in backtesting, what you want to do is be overly cautious. You want to see the losers. You definitely want to spot the losers, and you definitely want to make sure that you're not accounting for trades that you wouldn't be in real time. You want to get as close to real trading as possible in your backtesting. Okay, you want to lower your expectations of the strategy or performance, if anything. Okay, because we can handle doing better in real time. What we can't handle is doing worse in real time, right? Big takeaway there. So we go to the next one and we say, okay, well, it's 24th. Now it's the 25th. We go on, you know, and later that day, looks like we get another one. We go oversold here, right? So we go oversold on this candle here, which is our candle. And then we're going to enter the next bar market, which is right here. So let's bring on our tool again here. And we're going to say, okay, right. Our stop loss goes, what did we say, 15 pips? 15 pips below the entry, 15 pips below the low is going to be here, right? And then our target we said was 25 pips, right? So 25 pips. So this again, 1.67 to 1, really great. We know 1.67 to 1 is our reward to risk profile. And in this case, we've got targets at 33.59. So again, we go back and we go, right, the entry was here on the 25th at 7 p.m., right, 25th of the 9th, 2025. This time it was at 1900, again, GBP, USD. You can actually just copy all these down. You know, we're just going to do a test on here. We're just going to do a test on here, right? RSI, you can copy that one down as well. Right, and by the way, you can get this template. I'll put this in the description, this template. You can go and download this. Okay, and we're always oversold, right? So there you go. So there's our entry date, entry time. Our entry price on this one is going to be here. So 33.34. So 1.3334. That's going to be our entry price, and then we're looking at a stop loss of going at 33.19, so 1.3319, and then we're going to have our target at 33.59, so 1.3359, and there is our next trade. Now this one also hit target. It's going to be this is looking good. Might have to go and test this fully, but you can see that we hit target. So our P&L on this one is obviously going to be another 25 pips. So we know it's really simple. We know it's a 25 pip. Whoops. We know it's a 25 pip strategy because that's what we've set it out to be. Right, 25 pips. And from this tested data, you can then say, oh, look, because you know it so well, did I leave money on the table? Could I add another position? Could I split the contracts in half and take 2 targets? Or trail stops? But you wouldn't know any of that if you hadn't done this process. Crazy to think that people just trade blind, right? I'm not going to do too many more, right? In fact, I won't do any more. You can go, you get the point, okay? You just go and look for RSI to be oversold. You know, you find the next setup where we're oversold. below 20, and then you start tracking the trade, right? So you go here, you see there's an oversold here, right? Don't know where the chart's gone. But you get the point. You get the point, right? So we're oversold here. Again, you'd be oversold here, so you'd enter here, stop loss below the low, you take targets, right? So you'd be like in here, 15 pips on the stop, which is here, 25 pips on the target, which is going to be here, right? And then again, you put all the entry rules in, you go and do the next one. You go to your spreadsheet. All right, so next one is 5th of November 2025, and then this one is at, whatever, it's 1 a.m. Okay, so 1 a.m. this one. So you get the point. And from this, you're going to get 100 trades or 5 years, okay? And then you're going to analyze the data on this to find a positive expectancy, the strike rate, the maximum drawdown, the maximum loss in money, okay? And you're going to understand all of that stuff so that you know whether that strategy is worth trading or not. Now, once you've done one test, you can do multiple, and then you can put them all together, and you can start to see how some setups complement others, and some strategies complement others, and how one of your systems might be in a drawdown over the summer on average, but you have another system that keeps that afloat and makes your nice smooth equity curve. You won't know any of that if you don't do this testing. Okay, so what I want to do now is take you over to the real good stuff. I'm going to show you a deep dive to blow your mind, expand your mind into one of the most comprehensive business tools that you need as a trader that you won't see anywhere else online. So let's get stuck into that now. All right, so in this part of the video, I'm going to walk you through the functionality and the proper use of the Tier 1 trading backtesting and money management workbook. Now, this is probably going to be more advanced in terms of Excel spreadsheets than 99% of anyone watching has ever used. This is far beyond what I've seen online anywhere. So you're going to want to kind of save this video. So if this is the first time working in Excel or with a spreadsheet that does this type of functionality, then it's all right if you're a little overwhelmed from the start. But as you'll see as I walk through this, I'm going to explain each and every part, what it does, how it operates, and how you can use it to benefit your trading. So the first time you open up this spreadsheet, it's going to look like what you see here. It's not going to look like too much. There's going to be a lot of empty fields, a lot of graphs that aren't populating any data. That's how it's supposed to be, okay? This workbook really broken up into two primary sections. There's a backtesting section, which consists of the backtesting spreadsheet, the money management spreadsheet, and the backtesting tune-up sheet. And then you have a live section, which consists of the trade log, the live equity portion, and the live tune-up. Now, since the backtesting portion is what you guys are going to be using first, that's what this video is about, that's where I'm going to start. So as we open up the backtesting sheet, the first thing you're going to see is a bunch of fields up top. You've got net pips, count equity, lots per target, etc. And you have some graphs over there that aren't populated. That's okay, that's how it's supposed to look. So we're really looking at putting data in underneath the trade data, order info, exit info, and the additional info. So basically up to column W are the ones we want to modify. And then once we get over to the results section, the C2, C2, the C1, C2, C3, close pips and all that, those will be formulas. So they'll be automatically populated based on the data we enter in the other fields. Let's scroll back over to the start. In column 13 here, I'm going to walk you through each one of these section by section and kind of explain a little bit about what it is. Some of them are self-explanatory, which we just explained, but there's going to be some that are crucial. Okay, so we've got entry date, as we did before. We've got entry time, so you might have 0800. Okay, so that would be the correct entry time. Now, if you started the trade at 1 in the afternoon, that would be 1300, so it's 24-hour. So the next one is the currency pair. Obviously, we've been through that before. You just enter what currency you're trading: euro yen, euro dollar, pound dollar, euro dollar. You just enter that in. If it's a pound yen, just enter pound yen. Next one's chart interval. So that's the time frame. So 4 hour, 5 minute, 15 minute, whatever, you put that there. The trading system is, as I explained, this is your different types of trading systems. So you might have multiple different trading systems. So you might have like a day trading, and then you might have a swing trading. The type of entry could be a number of things. This could be like, maybe you're an aggressive trader and this is like an aggressive entry. And then you could have more of a conservative entry. Okay, whatever. Maybe you did a limit order entry, or maybe you did a at market order, as I explained just now. This is just a place where you can identify different types of entry that you use in your strategy rules. The next one's ATR. So lots of our traders love checking the average true range. It's really, really valuable to add if, for instance, you're using ATR based stop loss. Okay, a lot of the patterns that traders use an ATR based stop loss, and that's useful to keep an eye on as you're testing this data. It's also good to keep check on the ATR anyway, just to see what the average true range was at the time of those setups. The CTS is combined technical scoring. That's one of the strategies we teach at Tier 1. So if that's something you're using and you want to identify what the specific score was for the trade that you took, then maybe your trading system here would have been a CTS trade, and you'd put the score. The score might have been a 6 or on that one, right? So this is another place where you can put a little more information about what type of trade that you took that was unique about the setup. The more unique you can get about the setups, as we get into the backtesting tune-up and the live tune-up, I'm going to show you how you can take all this data here and really manipulate that data to really pull value out of your trading system, out of all the data that you collect. So it's I say this all the time, it's good to have data, but if you can't populate it in a way that makes sense and is really valuable and helps you become more profitable, it's really no point having the data anyway. So the more you populate in these fields, the more you might gain from going back and looking at your historical performance, and then you might identify something specific about your trading that you might just be able to modify or tweak a little bit, and it have a significant impact on your performance or your equity long term. So again, just another field there that you can add in, CTS score, if you're a Tier 1 trader. As we go over into the order info section, same as before, entry price, pretty self-explanatory. Whatever your price point is that you entered in, right? 1.2345. You could have 4 decimal points there for a pip value. If there's a yen pair, obviously you might have 2 decimal points after. Then you're going to get to the initial stop loss. So that's whatever the stop is going to be for the trade that you took. Target 1 price, target 2 price, target 3 price, just the same as before. Now, if your specific trading system or trading method doesn't have a target 1, target 2, and target 3, that's fine. You don't have to enter something into these data fields if you don't need it. So if you just have a target 1 or a target 2, and you just use those. If you just have a target 1, you just use that, right? So you just leave it blank if you don't have a 2 or 3. Then we've got the exit info. Okay, so this is the close date, right? So the date that the trade closed out. So if your entry date was on January the 1st and you're in a swing trade, and your close date was 3 days later, so you get out on January 4th, then you put whatever the close date was in there with the close time. So you put the time at which you close out the position, whether that's a stop or target. And then position 1, position 2, position 3, exits, as I explained before. Okay, target 1, target 2, target 3. So these numbers might be slightly different, because if your initial target was somewhere, and then you've adjusted that target, then the position exit price might be different, right? So you might not have got as much profit on the trade as you initially anticipated because of trade management rules. Then we go to additional info, and this is where we're looking at MFE, which is MFA and MAE. So these are concepts that are most applicable to like system developers. So MFE and MAE is maximum favorable excursion and maximum adverse excursion. The reason we put those in this is because we do a lot of system development. And again, we want to have a lot of data that we can input that we might find useful later. So you might not need these and I'll do a whole video on MFE and MAE. If you want me to, just let me know in the comments. Type in MFE and I'll do a video on that. But let's just say you're taking one target and it's a 20 pip static target, right? So every time you get in, you're looking for 20 pips. But when we want to look at that over the long term, and you come back and you say, well, what if I did 30 pips? You know, would I have still made as much money? And if you're collecting the maximal favorable excursion, then that will show how much the market moved in favor of your position. So maybe you got out at 20 pips, but that move ended up going all the way to 80 pips, right? Before it turned around and reversed. Well, then you'd put 80 pips into that, and then it would show you how much money you're leaving on the table, basically. So it would show you the difference between those levels, that favorable price. So over the long term, if you took 1,000 trades and you got out with a 20 pip target, but you realize that 75% of the time the market moved at least 40 pips in favor of my entry price, well, maybe you want to look at adjusting that. Not going full bore, but maybe you want to adjust it to 35 pips or 40 pips, right? What happens if we push it to 60 pips? You really wouldn't know that. You'd have to go back and do more backtesting to find out if that would be valuable. But if you collect it beforehand, then it's something you can make a really quick adjustment on in the long term. So maximum adverse excursion is how much did the market move against you. Okay, so the same thing, if you had a 20 pip stop, but you see that, look, 80% of the time, the market only moved against you 15 pips, you might be able to tighten up that stop loss a little bit and save yourself some risk. And that might be really, really valuable over the long term. So those columns there are for real advanced developing testing. I do a lot of development testing over the Christmas period in particular, and it might not be valuable to you, but it's there if you want to use it. Next, we have chart notes. So that's what I recommend you have, some kind of chart note. It might be news event that comes out, it might be some specific you know, this was a trade that we had, major news event, and ECB came out and a press conference came out and it moved the market, and I just want to make a note of that. Then that's something you can add here and look at in hindsight. The next field we're looking at is the rules followed, 100%. So why would you have put that field here? Well, we know that traders don't always follow their rules, okay? And that's really important for you guys to know, because even if you have a winning trade but you didn't follow your rules, it's important to make a note of that, you know, because winning money as a result of not following your rules is not to be celebrated. You want to approximate zero gross performance discrepancy. You want to trade your trade plan flawlessly. And what you don't want is if you took out all the trades that didn't follow your rules, you might be negative. Or maybe all those trades that you got lucky, you might be negative, right? So you need to keep an eye on 100% followed rules. So this is just a place where you can just get a little honest, you know, we're not tracking it in the data anywhere, but it's just for you to keep an eye on. You just click yes or no. Did you follow your rules? Yes. Did you follow your rules? No, this time I didn't, right? This next one is errors made. So it coincides with the rules followed, but if you didn't follow your rules one time, you might go over here to the errors made and you say, do you know what, I was emotional, or I missed the order entry. You know, you might have had fat fingers and you accidentally put a extra 2, or to put the stop 10 pips higher than it should have been, or whatever. You made an execution error, a human error. If it was a trade management, you know, you might be like, well, I took target 1 and I was supposed to let target 2 ride, but you know, I decided to I got my whole position off at target 1 because I felt like it. You know, maybe that falls into fear or greed. Maybe it's a trade management thing where you thought you were supposed to take 1 target, but actually you should have taken 2 targets, and now you're like, Or it might be a fear and greed thing, right? Where you're just nervous and you want to close out the position, or you're scared or whatever, right? So it's going to allow you to track that long term and find out, where's my issues at? Because 80% of this stuff minimum is psychology. So you might want to know what's wrong with you. You know, what are you making errors, or are you making, you know, emotional errors? What is it? So yeah, great thing to track. So that gets you through all the fields that you can populate in this particular backtesting section of this sheet. Once we get into C1, C2, C3 and total close, those are going to be formulas, and they're going to be calculated based on the entry position and the stop position, and then all of the data that you put in here, position 1, 2, 3, exits. and I'm going to show you how that works once we get into some sample data. Okay, so after we work through each one of these sheets. So that gives you a pretty good idea of the different fields, okay, that you can add that data to and what they're going to do for you. Now, the question always becomes, people open this up and they've never worked in Google Sheets or Excel, and they're looking at all these fields and they think, oh, this seems like a whole lot of data that I don't collect now, and I don't really want to. Like I said, the more data you collect, the better it's going to be for you long term. But I understand that sometimes you just don't have multiple trading systems. So do you really need to add that? Well, the answer is no, you don't. There's certain fields that you need to enter in order for the data to work, but there's certain fields that are optional, okay, and you don't need to enter. So for the backtesting and the trade log section, which is the one that we're on here, right? And if I click over to the trade log, you're going to notice it looks almost identical to the backtesting sheet, and that's again by design. But getting back to the backtesting, there are input minimum requirements, okay, that have to be added or populated in order for it to be able to pull the data and work the money management calculations and for the formulas to work. Those requirements are the entry date, the currency pair, the entry price, the initial stop loss, and at least your position 1 exit. And the reason why those fields are critical is that the money management is developed on a weekly basis. So it's looking at, how did I do this week? How did I do the week after it? So we need to have that entry date so that the sheet can calculate how much time has passed, when to look at the next week, and so on. So you have to have the entry date, have to have the currency pair. The currency pair because we need to call to the pip values that we have here. And I'll walk you through that at the end of this video, because you don't have to do a whole lot of this modifications to this at all. But you need to have the currency pair so it knows what the value of a pip is when we're trying to look at it, right? What's my account equity growth over the long term? So you have to have entry date, currency pair. The next one we had to have was entry price. Obviously, we need to know where we got in. We need to know what the initial stop loss is. And the reason we need to have the initial stop loss is when the sheet looks at your entry price, it says, okay, I got in at 123.45, and then you put in your stop loss. It's going to look at the entry price and it's going to look at it in relation to the initial stop, and it will automatically know, is this a long or a short trade? So that way it knows that if it gets filled, then it knows if it was a loser versus a winner. So we have to have all of those, initial stop, and then we have to have at least the position 1 exit to know the P&L, right? So if we're in, we need to know where we got out. All right. So if you have just one target, you have your position 1. If you have 2 targets, you have position 2. And if you have 3, you have 3, right? But 1 is a minimum. So those are the minimum field requirements needed to actually get this spreadsheet to populate and to do, some of the cool things that it does, which it does a lot of. So just to kind of stay on that topic of what fields I can modify and which ones I must modify, let's just quickly go ahead to the money management section, and I'm going to walk you through which fields on there you can actually change and which ones you need to leave blank. So looking at this is going to look a bit different from the backtesting section, obviously. And you're going to see a couple of graphs here that one's fixed size and one's money management, and then they're not populated yet, but this is going to be a smooth ratio money management that we teach inside Tier 1. And these are going to be graphs that pull data. Once we have our backtesting data and all the backtesting data populates down here, you'll see your equity growth on what it looks like if you use a fixed position size versus a smooth ratio money management principles that we teach at Tier 1. But when we're looking at the fields that can be modified on the money management sheet, the first one we're looking at is the starting account equity. So this is where you just add in or change whatever your starting balance is in your account. So if you're trading a demo account, it might be a $3,000 account. Okay, you just add in $3,000 there. If it's a $5,000 or $500 account, you just enter that there, and that will populate that. If you're trading a $500,000 account, likewise, that's the first one you can change. The second one is the max acceptable drawdown. So this is going to be what are you willing to lose? What are you comfortable? What's the maximum exposure that you're willing to lose? And the money management sheet is going to look at all of your backtesting data, and it's going to say, okay, based on your backtesting data and the performance of your systems and the combination of the systems that you've got, do you fall within your desired maximum acceptable drawdown, right? And if you exceed that, it will tell you. It will say, hey, look, you told us you only wanted 20% drawdown, and the rule set, the backtesting data that you've got is showing a history of potentially a 32% maximum drawdown on a $5,000 account or whatever it is, right? So that's the second one that you can modify there. The third one is the max weekly drawdown. So maybe you're willing to have a 40% max acceptable drawdown. Okay, maybe you've got the tolerance for that, but you don't want to get all of that in 1 week. You know, maybe you're willing to use 40 overall, but you just can't stomach losing more than 15% in 1 week, say. So you can change your max acceptable and your max weekly drawdown based on your backtesting performance and your preference. The next one is the lot size. This is a drop down here. If you click on the drop down, we have standard lot, mini lot, or micro lot, and that's pretty self-explanatory. You can change that to whatever lot size you're using for a specific trading account. And then we're going to move over to the money management profit trigger. Now this is going to look at a dollar amount, and it's going to say, okay, if we're using the smooth ratio money management principle, then how much money, how much equity do we want to increase before we start looking at increasing the position size? Okay, so the way it's set right now is at $1,000. If you're trading a $5,000 account, what you're saying is, what you're telling the formula is, I don't want to start increasing my position size until I've grown my account from $5,000 to $6,000. Make sense? And then if you're ready to ramp that up sooner, you might say, once I've made $200, I'll start looking at increasing my position size. Okay, and when we're looking at that, let's just say we leave it at 200 and we bring our account up to 5,200. Then the next one is the money management acceleration. So this is going to say, okay, when I increase my account equity by my profit trigger, then what is the acceleration of lot size that I want to increase it by? So if it's at 1, so let's just say you're starting out at 5 and you're trading 5 micro lots for every trade, and you're saying, once I make 5,200, I want to increase by 1 lot. So once I make 5,200, then I'm going to increase to 6 micro lots per trade. Okay, so this is going to help you limit or speed up or reduce the speed at which your position size increases. Okay, the next one is the start size. So this is not a field that you can edit. It's not one that you should edit. This is actually a formula, and this formula is going to look at your back testing, and it's going to say, based on your back testing results and based on your starting account equity and based on your maximum acceptable drawdown and your maximum weekly drawdown, then we can look at the max profit trigger, your account acceleration, and it's going to say, based on all those things combined, this is the number of lots that can work, that could really work with your specific system to keep you within range of the parameters that you've identified here. Now, if you want to do a customized version of this, and you don't want to use the formula version, and you want to do a manual start size, then you just switch this parameter here to yes, and then you can come and change this one, okay? And you can put whatever you like. So you might say, hey, look, I've been trading this system for 2 years, and I'm already trading 10 mini lots, so that's where I want to start out. You change the manual start to yes, and then you can put in 10. So you put that in as your position. Make sense? And then once we put in all of our backtesting data, it's going to use 10 as the starting point instead of whatever the system is calculating based on the performance that it's looking at. So these columns, the manual start size, the acceleration and the profit trigger, and the account equity and the max drawdown and the weekly drawdown and the lot size, those are the only fields that on this sheet that you'll edit. Okay, when you get down into these sections, you don't actually put any data in here. It's going to pull all of that data from the backtesting sheet. It's going to run a bunch of formulas, run a bunch of algorithms, and it's going to provide you with all the optimized data in this area, in all these columns. And again, I'll show you through that as I walk you through that, and I'll show you what it looks like as I put sample data in there as well. So that's taken us through the backtesting sheet and the money management sheet. The next one is the backtesting tune-up. And the first time you click over to this, you're not going to see much. It's just you're going to see, well, this is broken, you know, looks like something's not there. And you'll probably think, oh, that section of the sheet doesn't work. And that's because there's no data in the backtesting sheet, okay? So you only activate this and slice the data once there's data in there, okay? To give you some useful information and useful insight that I haven't seen any other traders do online. Now I'm going to skip over this one for a bit because it's not going to make sense until we put data into the backtesting sheet. So I'm going to go onto the trade log. Kind of touched on this earlier. This is almost identical to the backtesting. In fact, it is identical to the backtesting. The only difference is the backtesting sheet is used for backtesting and the trade log is used for live trades. So if January the 1st is the day you went live, then that's the day you start adding in the trade log, right? All of the testing prior to that would be backtesting. This is your live trade journal. As I said, it's your continued backtesting going forward so that you can journal and you can make sure you'll keep on top of this stuff. This is basically your trade journal. Once you start live trading, this is where you use the live trade log. There's two real sections to this tool. It's the backtesting and money management, and then there's backtesting and then there's live. So the trade log has all the same formatting: entry date, entry time, currency pair, all that kind of stuff. It's all the same. And then we have live equity. Okay, so live equity looks similar to the money management. Okay, it's actually going to pull the data from your money management and it's going to say, okay, well, this is where we added our starting account balance, our max acceptable drawdown, our profit triggers, and the live equity is going to pull all of the information from here, the parameters that you set, and then it's going to look at your trade log, so your live trade log, and it's going to say, okay, based on those parameters and your live trade, our live results, what's our equity doing? Okay, so if we're at 5,000 and we start, we 15, 20 trades in, what does our account look like based on the money management parameters and the results of those live trades in that trade log? So that's what this one's going to do. You don't have to edit any of the data in live equity. You don't put any of these fields. You just leave them be. This is automatically going to populate. This is a view only page, pulling data from money management, populating in here, and then it's going to be your live trade log. So this is where you keep an eye on what your live trade is. And then the live tune-up looks like the backtesting tune-up. So if you don't have any data, you're not going to see anything here. So what I'm going to do now is I've already got some sample data here. I'm going to populate this and show you how this all comes to life and how this makes sense and where the real power is in doing this, because this is going to blow your mind. So now we're going into what the spreadsheet actually looks like once you start adding data. And as you can see here, we've gone in and we've pulled the minimum requirements, right? So we've gone historically back in time, added the date, the currency pair. I did add the type of entry, so we just gave some sample entry types because I want to show you what you can do with that when we get to the tune-up, the backtesting tune-up. But we've added in the, this is all test data, okay? This is test data. We've got a variety of currency pairs, we've got a variety of entry types, we've got entry prices, stop loss, and then we've got position one, just a two target system where we've got position 1 and position 2. And now you can see in that C1, C2 and total close, that's now calculating, right? And we didn't have to do anything to get that in. Okay, great. So this sample data has come from some of our traders testing, and there's about 200 lines of data in here, I think. Let's just take a look. Just over, yeah, about 200. Yeah, just over 200 trades. Gives you a nice little sample size there of what the sheet's going to do. And now, when we look up at the top, you can see all of these have changed. You've got values, right? They're showing you some data. So what am I looking at? Net pips, 4,807. That's how many pips we made based on these trades. My account equity, what's that at now? My lot size is, what the gross win is, what the average win is. Phenomenal, invaluable. My expectancy, my profit factor. number of trades that I've logged, our average losing streak, max losing streak, our max consecutive trades lost. Again, really, really useful data, because the more information that you have about your system, the more confident you're going to feel about trading it consistently and trading it correctly, because you've got confidence in numbers. When you can go back and look and say, well, look, I've got 2,000 trades across all my systems, and I know that every now and then my system's going to fall into a drawdown, and I know what that looks like historically. I know that it's not uncommon for me to see 4 losers in a row. You know, if you see 10 losers in a row, maybe. Now, if you know that, and you've been aware of that beforehand, then once you get into that period, it's going to be a whole lot easier for you to just continue to do what you've got to do, place your trades, stay consistent, trade through the drawdown, because you know it's not out of the ordinary. But likewise, if you've done 10 years worth of backtesting on a specific system, and you know that like my max drawdown is like 15 losing trades in a row, and all of a sudden you're at 25, you know, it might be time to look at that and go, oh, maybe the market's changing. You know, maybe my ATR based stop or my ATR target is changing because volatility's just tanked and there's no movement in the market. So yeah, I'm taking a lot of losses, right? It can give you some quick insights so that you don't bleed dry. So that's why I've added this data here. It's invaluable. And then over here, you can see the win-loss percentage. So the graphs are starting to populate up here. We've got win-loss percentage, 41% losers, 58% winners, and 1% scratch, just broke even. Exited at your entry point for whatever reason. Maybe it was news, or maybe just graceful exit. Errors made. You know, we haven't populated that because we haven't added in any errors. But if we do, let's just go in here and say this was an order entry issue, and you know, down here, let's just say this one was a fear and greed issue. And now you can see 50% of my errors were order entry errors and 50% were fear and greed. Again, you can start to see where your problems are. If you're making loads of mistakes, you can say, well, what mistakes am I making? Because as a trader, you have a small edge as it is. You really can't afford to make many mistakes. So you want to be on top of mistakes and errors. And over here, we've got closed profit. And that's going to show you closed profit based on your target 1, target 2, and we don't have a target 3, so it's not showing any closed profit on that, but it'd be target 3 as well. So I've showed you what it looks like with data here, and I've shown you how the graphs are populated and data's populated here, and I've shown you how the closed pips are going to populate. So once we have our data entered, then we can go to the money management table. And as you can see, it looks a whole lot different than it did 5 minutes ago, right, when we looked at it the first time. So now you can see, okay, well, I've got some equity curve going on here, and I can see that there's some movement. That's good. And we've got some data to look at. What this one's going to look at is your fixed size. So your fixed lot size comes over here and says, okay, based on the performance results that I added in my backtesting data, and based on my $5,000 account and 20% acceptable drawdown, no more than 10% drawdown in a week, trading a micro lot, I've got a profit trigger of 1,000 and my acceleration is set to 1. Based on all of that data combined, it's saying, okay, the start size for that start type of result is going to be 7 lots. Okay, so that's what it's saying. So if we're at 7 lots starting out and we're using a fixed lot, and this is never going to change, you say, I don't want to increase my position size. I always want to stay at 7 lots. Okay. So this is what the account equity is going to look like. This is what the profit and loss is going to look like. This is what the percent change is going to look like based on those trading results and that fixed position size. Okay. So as you scroll down here, you're going to see this the first column is going to be your week number. Okay. So as I said before at the beginning, this spreadsheet's built on a weekly basis. So if you finish your trading week, it's going to populate that week's worth of data after the week. Then it's going to look to your second week. And so that's how all this is working here. So this is the result that I made, 178 total pips during week 1. And then I made $135 on those trades. And my equity growth was 3% for that week. And then I got into week 2 and I hit some losers. I ended up losing 398 pips. And at 7 micro lots, I lost $267. The account equity is down to 4868, and I had a 5% drop. So that's how to read and interpret the data here. Okay, it's going to go week by week, show you what the results were. Now, if we scroll over to the money management section, this is what it's going to look like if we apply a money management smooth ratio formula. Okay, and you can see we start out at 7, pretty much the same. It's all pretty much the same. If we scroll down, you can see week 24, we can see, okay, we went from 7 lots to 8 lots. Now, because I grown my account to the recommended number, I grew it to the point where I was ready to start increasing my lot size. And as you can see, you continue to trade it, and then you're trading 8 lots. Then once you get down to here to week 31, you made some more money, and now you're at the point where you can grow again. And now it goes up to 9 lots. If I go back here, this is one of the amazing things once you had all the backtesting data. You can say, okay, what if I change my methodology a little bit? Okay, what if I increased my acceleration? So instead of a 1, maybe I increase this. Once I increase by $1,000, maybe I increase it by, let's just say 3 lot increase. What happens if I do that? Well, as soon as I did that, you saw that this changed. And it says max weekly drawdown hit, because that's a big bright red flashing error message there to say, hang on a minute, if you make that change, you're likely to, you're not staying within that parameter that you told us you wanted to stay in, right? So now you can either decide to stay in that and say, do you know what, I'm okay, or you can adjust it to suit you, right? But maybe you're all right to take 20% because you really want to increase by three lots, then it's good to go. So if you're willing to accept a 20% weekly drawdown, then it's okay to increase by 3, because if you do that, then you'll stay within your parameters based on your backtesting results. So when we looked at it the first time, it took us a while before we started increasing size, but now we're accelerating, right? So now it's going to increase a little bit sooner. Week 13, much sooner than it did the last time, right? Scroll down, we're higher, and then at the last week, we're now up to 13 lots, right, instead of 9 or whatever it was. Again, we can change this and maybe want to increase a bit sooner. Let's just say $200, okay? Now it's saying, oh, hang on a minute. If you do that, if you increase that quickly, you run into a big problem because you've exceeded your max acceptable drawdown. So maybe you found a parameter that you think, I don't really need to go over that. I don't need to get so aggressive in my position sizing. I need to make sure that I'm growing slower. So I'm going to go back to 1500, say. And I'm going to change this accelerator back to 1. But as you can see, there's a lot of things that you can do to build your system. This is what I always talk about when I say you build your trading system for an optimal setting for you based on your backtesting results. This is why it's so personal. There's not one single right way to trade or do this. It's, if you've been with Tier 1, you'll know that we tell you need to customize your strategy to fit your personal trading style and your lifestyle and your personality. It has to fit your risk profile. This is the beauty of doing this. And there's nothing out there like this, doing this. And this is the only way you're going to be a profitable trader. I hate to break it to you. You spend some time going around this and you play with it, and maybe you want to stay with a fixed lot, or maybe you want to work with a smooth ratio money management, but you just need to do some adjustments and make some changes to your acceleration. Maybe you need to reduce your max acceptable drawdown and maybe change what you're doing a little bit. But this gives you ultimate flexibility to give you optimum performance. And it helps you identify where that sweet spot is for your specific trading setups. One thing I do want to make note of, though, is to get the most out of this tool, you need to understand what it's designed for and what it's not designed for. So this has been created to give you transparency, clarity, and a 30,000-foot view of your trading, to give you a new perspective of your trading and look at some data that you might not have looked at before, or 2, you might not have been able to manipulate to make some changes and really quickly at the click of a button find out, okay, well, if I make this small little tweak to my trading, how does that affect my long-term growth? That's what this does. This is what this is designed to do. What it's not designed as is accounting software, okay? So if you're looking at your live trading account and your account equity and your broker account, and you're going, I started out with $5,000, but my account equity isn't showing after week one, 51,135 or 51,35, it's showing 51,72 or something. This is not designed to be to the penny, because the reason not is because we don't know what broker you're with, spreads that your broker might be charging, commissions your bank account might be charging. You know, your bank account, you might have different fees that we can't track here. So I talked to you about pip values. When we went to backtesting, I told you that you needed to know what the currency pair was. And the reason we needed to do that is because the money management sheet called to the currency pair and it says, okay, what's the pip value? What's the value of a pip for that currency pair at whatever your lot size is, right? So if you're trading pound New Zealand and you're trading a micro lot and it's 0.07, that's what the money management sheet is using to calculate equity growth and profit and loss. Now, if that's slightly off from what your bank has, you know, let's just say it's saying 0.0753 or whatever their calculation is based on their variation in a day or a week or a month, then those aren't going to be accounted for in the money management section of this sheet. Likewise, it's not going to account for broker fees or spreads and slippage and those types of things. So it's important to know that, you know, it's not your accounting software, but it is a superior trading backtesting tool and journal tool that I haven't seen anything else like. It's going to get you closer to your system and give you more confidence and increase your psychology and your ability to trade as a professional more than any other tool out there. All right, so let's assume that you've got all your backtesting data done and you've run through what your money management is and you want to start looking at pivot tables and tuning it up and looking at your backtesting data and really gaining additional value from it and optimizing the performance. So we go into the backtesting tune-up. This is what you're going to see. And it doesn't make any sense. The first thing you've got to do is you've got to come into this little square pivot table, right-click on your mouse, and then click Show Field List. Okay, and now you're going to see this pop up on the right-hand side. And it's going to have all kinds of different data fields here as well that are populated throughout your backtesting and money management sheets. Now what we can do is we can start analyzing certain aspects of our trading. So let's just start with, let's do type of entry. Okay, so I'm going to click on this box here and it's going to drop it down here into the row column, right? And we can leave it there. And then the next thing I want to look at is currency pair. Because a lot of people ask about, do I need to put all my currency pairs into one, or should I do multiple spreadsheets for each currency pair? So let's go and click on currency pair as well. And then I want to look at my my wins and losses. So my close pips, how much am I making on my trades? So this one, there was 2 targets included in this data, this particular dummy data. So I'm going to click on C1 and C2. So now we've got some numbers populated over here, and I'm going to grab one more piece of data. I'm going to do name of day, and I'm going to add that in here. Okay, right. Okay, so now you can see, okay, I've got the cipher pattern. If we go, this data is test data, but it gives you an idea how to manipulate it to show you some stuff that it can do. But these numbers are just test data. Okay, so I don't want you to read too much into the actual figures. It's just to give you an idea of how it works. So we have our cipher pattern, and that's the type of entry that we're analyzing. Now I want to drill down and look at each currency pair. You know, what's my profit? How much am I winning on target 1 on the Aussie dollar? How much am I making on target 2 on the Aussie dollar? If I go down to the euro pound, target 1, 880 pips, target 2, I'm getting 333. So now you can start looking at this and saying, okay, well, you know, some of these are performing really well. Pound dollar, 2800, both target 1 and target 2. But on the New Zealand dollar, I'm really a bit above break even on target 1 and negative. When I look at target 2, I'm really losing. So it wouldn't make sense to just continuously trade that blind. And this is what traders do. So from that, maybe you're like, I don't want to do target 2. Maybe I don't want to trade it at all. Maybe I just want to remove it from my portfolio for this strategy, this particular strategy. So then maybe you evaluate and do testing on 10 pairs and you're trying to find the top 6. Well, you're looking specifically at the cipher pattern and you're looking at this 10 market portfolio. Now it's really easy for you to go in and say, okay, well, you know, Aussie dollar, that one did pretty good. Euro pound, not so great. Pound yen, that one did amazing. That's probably my best one there, so I definitely want that one in there. Pound dollar did, you know, that's my second best one. Probably going to take out New Zealand dollar because from this portfolio. So you can start to drill down. Now, if you want to go even further, you can say, okay, well, I want to look at this per day. You know, what are my best performing days? Maybe I don't want to trade Sunday through Friday. So let's drill down and look at these numbers and analyze the data. Maybe we can clean some important, or get some important information from this. So you're looking at, you know, Sundays and Mondays on the Aussie dollar. Friday, not a good day. So maybe you should take Fridays off. And you're not a slave to the chart, looking at spending time at your charts when you don't need to be there. Friday's here, Euro pound. Yeah, I made some money there. Friday on the Euro yen, not so good. You know, maybe I want to get rid of that again. Euro New Zealand, Friday. Did okay target 1, not so much on target 2. Euro dollar. So you can start to look at this and you can say, well, you know, definitely don't want to trade Sundays because I'm not making much money on Sunday. It's not a very active day on Sunday night or Sunday evening. So I can eliminate that from my portfolio. So now I only do Monday through Friday. But let's look at that and say, well, okay, well, what if I eliminated Fridays? Now it's easy for you to look at that data and go, I'm not missing much here. Maybe I'm giving up a few pips of profit on this one. But in total, you know, maybe I can start drilling down and going, you know what? My trading days are Monday through Thursday. And that's when you're going to trade. Now you have the data to look at and really go, how's the best way to trade this system? So that's trading different strategies, different pairs, different markets, right? What we can do is if we're trading different systems and different time frames, you can take it further and you can start drilling down into that. So now we've got cipher, Gartley, bat patterns. We've added different time frames, so we can click chart interval and we can add that in here. And now that's down here as well. So now the chart interval is going to show up underneath Monday each day, which is really powerful. If we go to, let's find one where it's populated a different number. Here you go. So now you can see Tuesday 60. If we wanted to just look at specific chart intervals, we can click down here in these rows and we can drag them above or below to look at what's most important. So we've got type of entry, then we've got currency pair, but I'm going to change this to chart interval, or put chart interval at the top. And now we can look at all of the 15-minute trades, all my 60-minute trades, right? All my 4-hour trades. And now you can shift them around like that to see at a glance, very simply, very easily, what's the best performing setup. Now you might just want to put the name of the day, the top level field, and now just like that, you can quickly look and say, okay, well, Sundays just doesn't make sense to be trading at all. Sitting in front of my charts all day and waiting for stuff, and it's never happening. You know, it's just to eliminate that. So now I'm looking at Monday to Friday, and you go, do you know what? I can't trade Fridays. So what's it going to look like if I trade just Monday to Thursday? And then you can quickly see that data. Absolutely invaluable. Okay, and then finally, I want to say what I know I've shown you some really powerful tools there. A lot of questions that I get are about, what about automated software, where you basically just put some rules of a strategy in and then it will go and test it all for you. The problem with that is you're still relying on the software to tell you yes or no it's profitable. And if you don't understand or appreciate by now, watching this video, the difference between that and what impact that might have on your trading, I don't think there's anything else I can tell you. So my advice is, it's great to use automated software for maybe journaling. Once you know the ins and outs of your strategy, and you know the breathing pattern, and you know exactly why you're trading what you're trading. Once you're in that position, you can use automated software to do your journaling and stuff like that. But you don't want to be using it for backtesting. It's basically pointless. It might be good if you're doing some kind of test or some, for, I don't know, recreational data, or maybe you're running a report or doing something for, I don't know, some research. Maybe that's good, but not for where you've got to put your money at risk. So that is it for this video. I know it's been a long one. If you want to get hold of this, you can get this. This is the type of level that we go to with our traders at Tier 1 Trading. So I'll put the links in the details for Tier 1 Trading. I highly recommend, if you've got a lot of value from this, that's the place you need to be. You know, there's no other YouTube videos. Obviously, I've got my trading for beginners and all the rest of it, but if it's your time, just take the leap. Go and join somewhere that's professional. You'll get all the support and everything, all the tools you need to be a successful trader and stop wasting years going around in circles. So let me know in the comments how you found this. If you've got any questions, I'll answer in the comments as well. Until next time, have a great rest of your day, and I'll see you then.